Every single day, trillions of dollars change hands across the world's stock markets. But here's what almost nobody explains clearly: what is a stock actually, and how does any of this make ordinary people money? Let's break it down, step by step, so it finally makes sense. Start with the simplest idea. A stock, also called a share, is a tiny piece of ownership in a real company. When you buy one share, you literally own a sliver of that business. If the company owns buildings, brands, cash, and profits, you own a microscopic fraction of all of it. You become a part owner. That single idea is the foundation of everything else. Here's a useful way to picture it. Imagine a pizza cut into a million slices. Owning one share is like holding a single slice. You're not running the restaurant, but you genuinely own a real piece of it, and if the whole pizza becomes more valuable, your slice does too. So why do companies sell pieces of themselves in the first place? Money. Growing a business is expensive. You need factories, staff, research, and inventory. Instead of only borrowing from a bank, a company can raise cash by selling ownership to the public. The first time it does this is called an IPO, an initial public offering. The company offers shares, investors buy them, and that cash flows back into the business. In return, those investors now own a piece of the company's future. Once those shares exist, people want to buy and sell them. That's what a stock exchange is for. Think of exchanges like the New York Stock Exchange or the Nasdaq as giant, highly organized marketplaces. They don't set prices themselves. They simply match buyers with sellers, millions of times a day, and they make sure every trade is recorded and settled fairly. When you buy a stock through an app today, you're plugging into that exact system. What once required a phone call to a broker and a trip through a chaotic trading floor now happens in a fraction of a second on the device in your pocket. The technology changed dramatically, but the core job of the exchange never did: connect someone who wants to sell with someone who wants to buy, at a price they both agree on. Now the big question: why do prices move at all? The honest answer is supply and demand. If more people want to buy a stock than sell it, the price drifts up. If more want to sell than buy, it drifts down. But what makes people want to buy or sell? A few big forces. First, earnings, how much profit the company actually makes. Strong, growing profits tend to attract buyers. Second, expectations about the future, because markets are forward-looking and constantly pricing in what might happen next. And third, plain human emotion, fear and greed, which can push prices far in either direction in the short term. That emotional tug-of-war has names. When prices are broadly rising and optimism is high, we call it a bull market. When prices are falling and pessimism takes over, that's a bear market. A common rough rule of thumb is that a bear market means a decline of about 20% or more from recent highs. Both are completely normal. Markets have always moved in cycles, climbing, falling, and climbing again. Here's where beginners get overwhelmed. There are thousands of individual stocks. How do you track the whole market? That's what an index is for. An index is simply a basket that measures a group of stocks together. The most famous is the S&P 500, which tracks around 500 of the largest companies listed in the United States. When you hear that the market went up or down, people usually mean an index like this one. It's a single, convenient scoreboard for a huge slice of the economy. And indexes lead us to the most important lesson in this entire video. Historically, over the long run, the S&P 500 has averaged very roughly 10% per year in nominal returns, or closer to about 7% per year after adjusting for inflation. Now, please hear this clearly: that is a long-term historical average, not a promise. Some years are sharply up, some are painfully down, and past performance never guarantees future results. But over many years and decades, that long, bumpy climb has historically rewarded patient owners. There's one more way stocks can pay you, beyond the price going up. Many established companies share a portion of their profits directly with shareholders. These payments are called dividends. They're usually paid every quarter, and for long-term investors, reinvesting those dividends to buy even more shares has historically been a powerful engine of growth all on its own. Think of it like a snowball: each dividend buys more shares, those new shares pay their own dividends, and slowly the whole thing compounds. Not every company pays them, and dividends can be cut, but for patient owners they've long been an underrated part of the total return. So how does an ordinary person actually win at this? Here's the takeaway backed by decades of evidence. Trying to time the market, jumping in and out to dodge every dip, is extremely hard, and most people who try it underperform. Picking individual winning stocks is even harder, and even professional fund managers struggle to consistently beat the overall market over the long run. So what tends to work for regular people? Buying a low-cost, diversified index fund that holds the whole basket at once, investing steadily, and then staying invested through the ups and downs. Boring, yes. But historically, boring and patient has quietly beaten clever and frantic. Let's tie it all together. A stock is ownership in a real business. Companies sell shares to raise money. Exchanges match buyers and sellers. Prices move on earnings, expectations, and emotion. Bull markets rise, bear markets fall, and indexes like the S&P 500 measure the whole crowd at once. Dividends pay you along the way. And for most people, the winning move isn't trading frantically. It's owning a diversified slice of the market and giving it time. A quick but important disclaimer: this video is for education only. It is not financial advice. All investing carries real risk, you can lose money, and past returns never guarantee future results. Always do your own research or speak with a licensed financial professional before investing. If this finally made the stock market click for you, do me one quick favor: hit that like button and subscribe to Innovana Creation for clear, no-nonsense money explainers every single week. Your future, wealthier self will thank you. Thanks for watching, and I'll see you in the next one.